Welcome back. Not so good lead from Wall Street in the overnight session. The Dow giving up 93, the S&P down 10, the Nasdaq giving back about 27 points softer, backing off for a second session in a row. Yu-Dee Chang is principal and also chief advisor at ACE Investment Strategies. He joins us live out of D.C. Yu-Dee, always good to see you and appreciate your time. So listen, now we've got Evans, we've got Lockhart, we've got Fisher all talking about a September taper. Market, though, does not seem to like that very much.
No, I think today basically is you just don't want to get involved with a dull market, and that's what we had. And you're right. Throughout the day, every time the word taper comes up, the market take a dip to the downside. No, I think it's this. Basically, I think the market feeling is that the Fed was ready to pull the trigger, but this unemployment report last week sort of threw it off a little bit. So that's why they're sort of talking it up again and trying to get us ready for the tapering. It's probably going to happen within this year for sure.
Okay, listen, I mean, here's the interesting thing, though. Overall on the headline, a miss on the latest jobs report. But having said that, the unemployment component, big fall, 7.6 down to 7.4. I mean, that should have counted for something, right?
Yeah, and that's what Evan was saying, right? So it's getting closer to that the number of 7% that Bernanke was saying that where he was definitely going to taper, right? So although, like you said, the job creation number wasn't that good, but the employment numbers is getting close to the Fed target, and that's why the talks or the retalk of tapering in September is coming up again.
Okay, are you looking for a September start? Because, I mean, this is what we've been asking just about everybody who comes on the show. We're giving them three options. One, September start to taper. Two, December start to taper. And three, sometime in 2014. When do you think it's going to start?
Yeah, you know what? That's really a tough question. So if you put a gun to my head that I have to say it, I say September.
Yeah,
but I really think that... but I really think depends on one more month of data. If the next month data comes out, if it's not so great, that they might not. But if it's half decent, I think they're tapering.
Okay, Yu-Dee, what happens to the stock market when they do eventually start tapering? Has all of this been priced in?
Yeah, you know what, Lisa, I don't think so. I think initially we're probably going to get a knee-jerk reaction to the downside, okay? But, you know, we've done an extensive study into this. Would you believe it? Since the 1965, so for the past 50 years, we're not even raising rates yet, right? We're just tapering their bond purchasing program. Historically, since 1965, okay, during the initial part of interest rate rise, the stock market actually does very well. Think about it, it makes sense. That means the economy is just starting to grow, usually from a recession. And the market does well, interest rate goes higher. I think it's going to be the same. Knee-jerk reaction, maybe to the downside, but overall speaking, market does well.
But aren't things different this time around with all of the stimulus that's been injected into the system? And are you confident that the Fed's going to be able to maintain control of interest rates as they start withdrawing?
Yeah, that is a question. You know, you actually asked me this last time when I was on the show. I wasn't as concerned, but now I am actually a little bit more concerned, especially if you think about it, Fed accounted for 25% of the new gross issuing. So they bought up about 25% of it. On a net basis, even more than that. So if they were to leave the pool, don't think they're not going to change the water level. They are going to. So I am a little bit concerned, like you're saying, that they will not be able to control the rates. And maybe this great rotation of bond into the stock market will happen.
So what changed from last time to this time that all of a sudden has you concerned? Yeah,
you know what? My concern is basically on the market action, right? So like I let the market action tells me. Before the Fed even tapered, look the price of the bond fall, how much it fell back in the month of June. Just like that, it fell a lot. So I could feel it that people are getting nervous as much as people don't want to. Once the tapering does start to begin, I think they will start to dumping out of some of the bonds. And so that, based on the market action, is telling me it's a little kind of iffy there.
Great point. So is it bond yields that are going to torpedo this rally that we've been seeing with the market up 20% year to date? And are they giving you the heebie-jeebies, to use another technical term, Yu-Dee?
Yeah, absolutely. You know, on the short-term basis, but I'm laughing. On the short-term basis, I think it might have a negative impact on the market. But I think like I said, I think over the next, I would say 12 to 18 month basis, I think it's okay. I think the market, the economy is growing. There's no doubt about that. And I think on that merit alone, the market is going to go higher. It's just the bond market, I do believe that is in a little bit of trouble right now.
Okay, Yu-Dee, stay right there. We're going to come back to you in just a moment. That's Yu-Dee Chang. Absolutely.
That's why we love it. Yeah.
Yu-Dee Chang of Ace Investment Strategist joining us from New York. And we're going to go for a break now. Before we... Good morning. Welcome back to Squawk. Yu-Dee Chang is Principal and Chief Advisor at Ace Investment Strategist. He is joining us from Washington, D.C. this morning. So, Yu-Dee, looking at the VIX, boy, it's really plunged over the past month or so, which is interesting, seeing the markets are at record highs for the most part. What's going on? Is it still an indicator of fear out there, and do investors need to be worrying about protecting their downside?
Yeah, I think so. Basically, with a low VIX, that usually means a nice and smooth market, and no one's worried about downside too much, right? So that's why sometimes people use a contrarian approach, saying that, wow, when the VIX is really low, it's where you have to watch out a little bit. But don't forget, just because VIX is low, it might be going higher, doesn't mean that the market is going to experience a crash or a substantial down. A little bit of a 5 to 8% correction might bring the VIX right back up again. So I don't necessarily think it's going to be a major concern. As Sharia asked a little bit earlier, which I agree actually, if you consider the way the market has run already, and if you look at the seasonality factor, we're coming into the September-October period. So are we due for a little bit of pullback? Yeah, I think so. But I think along with many other market participants, we all believe that pullback needs to be bought. Actually, are buying opportunities. So I wouldn't be too concerned with a correction. I think that would be healthy for the market.
Okay. All right. So you get a pullback. If you're right, what do you buy then?
Yeah, I think there's a couple of sectors I like. One sector is the financials. Basically, from all the free money from the Fed has really helped them to make their balance sheet look really good. I think as rates start to go higher, they actually will be able to take advantage of the higher rates with their profit margin and make more money. So financial is one sector I will look, especially on dips. A second sector is the housing sector. If you look at the home builders, they had a spectacular 2012. 2013, this year, they're just kind of wandering up and down a little bit, and I think this tapering talk is depressing them a little bit to the lower end of the range. So on pullback, I will actually look for the home builders because I believe we're just start to see a multi-year run of that sector. Yeah, absolutely so. I think high mortgage rate, that might even be a trigger to push people into buying more homes. So I think if you look at U.S., we'll only see the beginning of a multi-year rise in housing prices. So I think home builders, for the longer term, I like them very much.
Okay, so you like home builders because of higher rates, but you're not touching gold with the 10-foot pole. Why not?
Yeah, if you think about the price of gold, gold is down what? About 32% for the year. Silver is down about almost 50% for the year. And if you look at the miners, they're even worse. So basically, I think the game is over there. Now, can you buy gold and go for a 5, 6, 7, 10% rise? Sure. But should you buy gold for the longer term, thinking it's going to go back to 1900, 2400? I don't think so. I think the game there is pretty much done. And don't forget, a lot of people sort of got suckered in too, where they are experiencing major disappointment. So I think for those people to get back into it again, it's going to take a lot. So I think trading opportunity, yes, but a major buying opportunity, I don't think so. I think the action is going to be still on the U.S. on the stock market in general.
Yu-Dee, post life after taper, or as taper continues or goes on, the unwind, a lot of people are saying that, look, it's going to make DM, developed markets, look a lot better than EM, emerging markets, especially those out in Asia. Do you agree? I mean, would you basically give this part of the world a miss?
Yeah, I actually agree with that. I think basically, I think these more mature markets, such as the U.S., I think it's going to outperform all the emerging markets, especially if you look at the performance of the market for this year. Clearly, right, the so-called BRIC nations, the Brazil, the Russia, India, and China, all four are down. And when you look at the U.S. market, it's just a little bit more mature. I think it's in front of the curve a little bit. So I would these days probably concentrate on the mature market a little bit more than the emerging markets.
Okay, Yu-Dee, great to talk to you. Do it again soon. Yu-Dee Chang, Ace Investment Strategist,
Absolutely.
live out of D.C. Still ahead, Disney and 21st Century Fox.